Last week we discussed interest rates, and also we looked at some various concepts relating to interest rates, and then we looked at interest rates in the context of Sri Lanka. And I told you there are various interest rates operating in Sri Lanka or used in Sri Lanka, and you know why interest rates are different, and there are various interest rates in the economy because of the risk and maturity structures in the economy. There are various levels of interest rates in the economy. Then I told you the Central Bank of Sri Lanka is basically uh, deciding the benchmark interest rates of the economy. Those are referred to as policy interest rates or the central bank interest rates, which we will look at in the next slide. I think we already covered. And then there are some other rates operated in the market. Those market interest rates are actually monitored by the central bank, and also after monitoring, the central bank calculates some of the average rates for the industry. For example, in the coal money market, they calculate the average rate for the coal market. In the treasury bill bond market, the central bank calculates the average rates for the bill bond rates. For commercial bank lending and deposit rates, average rates are compiled, and also there are some other rates. Started with this last week, and I also mentioned to you uh, the central bank is having few key interest rates, which we refer to them as policy interest rates. There are three policy interest rates actually decided by the central bank, and out of these two, three, the first two are the most important rates in relation to change in the monetary policy. Central bank is giving some indication about the changes to the monetary policy by changing these policy interest rates, or the first two rates mainly. What are the first two rates? SDFR and SLFR. SDFR is the standing deposit facility rate. SLFR is the standing lending facility rate. And I also gave you the definitions last week. Uh, I will repeat them. The standing lending facility rate is the upper bound of this corridor. There is a corridor. If you can look at this chart very carefully, the shaded area is a corridor, and the lower bound of that corridor is the standing deposit facility rate. Let me remind you the definitions of these two rates. Standing deposit facility rate is the rate that the commercial banks deposit their excess funds with the central bank. The rate that the commercial bank deposit their excess funds with the central bank. Standing lending facility rate is the rate that the commercial banks borrow their funds, shortages of funds from the central bank. Standing lending facility rate is the rate that the commercial banks borrow funds from the central bank for their funding needs. So these two rates work as a corridor. So I told you the lower bound and the upper bound. Lower bound is this DFR, upper bound is the SLFR. And I told you these are actually exam questions. The rate and the levels of rates. For example, SDFR currently 4.15. SLFR currently 5.5%, right? So there is a 1% gap between these two rates. So these two rates, these numbers are actually in your exam. Sometimes the examiner asks what is the current level of SDFR, SLFR, likewise. So you need to know these numbers because most of the time it's a 2 mark question for 2 marks. Okay, and unless the central bank changes rates before your exam, these are the applicable rates. One important thing of this rate is, as I said, these are policy rates or the benchmark rates in the economy. The central bank's monetary policy is basically indicated by these rates. So if the central bank is revising this corridor upwards, that indicates monetary policy is tightened or interest rates in the economy have increased. If the central bank reduces this corridor, that indicates the central bank has relaxed the monetary policy or some monetary expansion policy is practiced by the central bank. So when monetary expansionary policies are there, interest rates go down. If you look at this chart, you will see this corridor going up and down time to time, but it's not very regular. Right? Whenever the central bank decides, it changes the corridor. So the latest situation, if you look at since 2020, mid 20, we see corridor has brought down, which means currently the uh, monetary policy is basically relaxed. Interest rates are having low environment. Okay. And then if you look at this thick blue line on the chart, it is the bank rate. Bank rate is actually a kind of a rate for the commercial bank when they are in a distress situation. So you can define this rate as the rate that the commercial banks borrow from the central bank when they are in a financially difficult position. The rate that the commercial banks borrow from the central bank when they need funds in a difficult situation or when they have liquidity issues. Now, when they borrow, they need to give some securities, some collaterals. Even for the SLFR, when they borrow, they have to give collaterals like treasury bills or bonds. Similarly, when bank rate is applied, that is also based on collaterals. If you want to borrow from the central bank, you have to have some collaterals, right? Treasury bill, bondo, like some instruments like that. So this rate has been flat for many years. If you look at the upper part of the chart, you will see it has been constant for many years. Even for 2000, I think 10, 15 years back, it was very flat at 15%. Now, last year with the COVID uh, outbreak, the central bank reduced this rate as well. So currently, the rate is fixed to SLFR, SLFR plus 3%. So which means when the SLFR is reduced, this rate also goes down automatically. So as a result, at percent, this rate is 8.5%. So these three are the most important policy rates of the central bank.
Excuse me, sir.
Yes,
Uh, Usually we add 3 percentage with the SLFR when we calculate the bank rate.
yeah,
Is that a practice?
yes. Now,
Okay, sir.
in the past, it was decided by the central bank. Now, when SLFR goes down, automatically bank rate goes down because it's fixed to the SLFR.
No, I'm asking about the 3 percentage, sir.
3%, yeah. For example, SLFR is 5.5, no? 5.5.
Yeah.
You add 3% and it becomes 8.5. All the
Okay, if
time.
it is a SLFR is 4%, then we have to add 3 percentage. That's it. Even in the
Yes,
future also. Okay,
yes.
sir. Thank you.
Then we have the another rate, another rate in this chart, a red line within the corridor. So what is that line? It's called as AWCMR. AWCMR is the average weighted cool money rate. Average weighted cool money rate, which is the rate that banks fulfill their funding needs in the coal money market. The average rate where banks fulfill their funding needs in the coal money market. Now, coal money market we are going to discuss in detail in the market financial market discussion. But here, very briefly, the coal money market is a kind of a day-to-day market within the banks. In that market, people or the banks who are having excess money, they are lending. Banks who are having deficit money or shortages of money, they are borrowing. So banks who are having surplus and banks who are having shortages will transact in the coal market without any. Uh, Give me a minute, please. And I see some of your discussions in the chat, coal money market lending on within banks or anyone have any idea? So you were having some discussion. I think you were giving answers also, which is good. Actually, coal market is within the banks. Banks are the most prime institutions within financial institutions. We know if you take the financial institutions, there are banks, insurance companies, non-banks, primary dealers likewise. Banks are the most prime category. So within that, those banks, on a day-to-day basis, they have some funding needs. They have some excesses. Now, technically, I can explain this for a day, a whole day, because how this surplus and how this excess in banks come. I'll tell you a very simple, hint on that. I taught you this statutory reserve requirement, if you remember. So statutory reserve requirement is what is, I'm not displaying slides yet. I'll come back with the slides. Statutory requirement under that requirement, bank should keep some amount of money with the central bank. So when they keep that money with the central bank on a day-to-day basis, sometimes they are above that requirement, sometimes they are below the requirement. So based on this above or below situation, the commercial banks are having a surplus or a deficit. That's how they have a surplus or a deficit. So if they are above the statutory requirement, they have some surplus. If they are below the statutory requirement, they are in a short position. So this shortage have to be fulfilled. Excess you can lend to others. So when banks are lending or borrowing among them, you call it the call market. The word is call means it's very quick. You only give a telephone call to your partner or a counterpart and you get or you deposit money, you lend money. So based on the lending and borrowing interest rates, we calculate an average. That average is the average weighted coal money rate. Now this rate is important for the central bank. Now can you see the slide?
Yes, sir.
Okay. This rate is important for the central bank because central bank on a daily basis, the central bank monitors this rate and inject or absorb money to keep some stability of this rate. In other words, the central bank is trying to maintain this rate within this corridor or closer to this corridor. Now, this red line is the cold money rate. How the central bank is trying to stabilize this rate, it keeps within the corridor by injecting money or by absorbing money. Injecting money and absorbing money is happening through, if you remember, open market operations, right? Open market operations are the mechanism to inject or absorb money. So through that mechanism, the central bank is injecting money to the economy or the financial system, absorbing money from the financial system. As a result, this interest rate is maintained, the call money rate. Therefore, the call money rate is considered as the operating target of the central bank. Operating means you can manipulate it. You can actually have an impact on that. You have the control. That's the meaning of operating. So if someone asks, what is the operating target of the central bank's monetary policy framework? What is the answer? Average weighted call money rate. How do you define it? That is the average rate between the average rate of borrowing and lending between the commercial banks in the call money market, or we call it overnight short-term market. Okay. Any questions?
So within how many days a bank has to return that lending money?
On a following day. Now, if you borrow today, in the following day you have to return. Most of the transactions are overnight, and there are some few transactions for 7 days also, but mainly overnight.
Excuse me, sir.
Yes.
So is it higher than the bank rate?
Call rate is actually not higher than the bank rate. Why is that?
Alright, if bank rate is the highest rate, I think, according to the
Yeah,
diagram.
bank rate actually it's a kind of a, if you look at this situation, it's like a penal rate, isn't it? Banks very rarely come to this level because this indicates the bank is actually in a really a distressed position, isn't it? The rate is really high. Banks are discouraged to come to this rate because if they come to that, rate, that indicates the bank is having a problem. Normally, as I said, call rates and policy rates are moving very closely, not too closely. There could be some areas, some periods you have some divergence, but mostly they are very close if you look at this chart. Okay.
Okay, sir.
Excuse me, sir.
Yes.
Sir, we have heard something called the banks are booking for transfer pricing. What is the meaning of that?
Transfer pricing in the coal
Yeah.
market.
Is it relevant to this SDFR and SLFR?
No, 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 no. The transfer pricing is actually in international trade, not relevant to
Okay, thank you.
this.
No.
Can we move on? Okay. Then we have interest rates monitored and average rates are calculated for the government securities market. Government securities market means the instruments issued by the government for their uh, borrowing needs. As we know, governments are borrowing in the markets to fulfill their shortages. Funding means, for that matter, governments are issuing government securities. Some are domestic instruments, securities, some are foreign instruments. The most important government securities issued in the domestic market is the treasury bills and treasury bonds. So these are actually market rates, not decided by the central bank. Why we call them as market rates? These are determined at the auctions. Primary dealers come to the auction of the central bank and borrowing, and buying treasury bills or bonds at the auction. So at the auction, an average rate is determined based on the transactions and transaction volumes and the interest rates. So based on that, average weighted is calculated for these government security rates as well. What do you mean by this average weighted rate? Even in the coal money market, I discussed this average weighted rate. No? What do you mean by that? Is anyone having any idea? Average weighted interest rates. I think you can see my slides. I think I take an Excel sheet, then you will be very clear what I'm talking about. Can you see this Excel sheet?
Yes, sir.
Okay. Now let's say we have 5 loans. Loan number and interest rate. And amount. Okay. Now let's say we have 5 loans. 1, 2, 3, 4, 5. Then let's say we have different interest rate. Let's say we have interest rates 5.6, 5.1, 6%, 8%, and 7.1%. Then let's say we have amounts. At 5.6 we had, let's say, 5,000 loans. I'm talking about the rupee amount, right? LKR. Let's say we have a loan value of 5 million. At 5.1, let's say we have 3 million loan value. At 6%, let's put it as 6 point something, 6.5. At 6.5, we had 1.5 million loan value. At 8%, we had 2 million. 7.1, we had, let's say, 5.3 million. Sorry, let's put some higher value. We had 11 million loans, let's say. Now, if you want to calculate the average of these rates, interest rate, what you normally do is you simply take the simple average, isn't it? So in the Excel, you can simply take the average of these interest rates. What you get is the weighted average, not the weighted average rate. This is the simple interest rate. Clear? This is the average. Now, whenever you change this interest rate, it will change. Now, if you put higher value, 10%, this rate will go up. If you put here 3%, this rate will go down. So simply, it will be the average of these rates. Now, the issue is at these different interest rates, you are having different volumes. Those volumes matter. Why it is having a impact on the rate? Actually, the interest rate should reflect the value of the transaction when we calculate the average. So as a result, you have to consider these amounts when you calculate the interest rate. Now I'll use it as simple interest rates here. So what we have already calculated is the simple interest rate. But we need to calculate the average interest rate. You have to know this because your boss might ask, calculate the average rate. So it's not a big deal. How do you calculate? You first multiply the interest rate and amount. So simply multiply these two things. Then you have the weighted, then you have the volume multiplied by the interest rate. Then how do you calculate the average from this multiplication? You simply take the totals of these amounts. Here we take the sum of total volume and the sum of total interest rate into the volume. So both these are sums. Sums means you have taken the total. Now from this it's very easy to calculate the weighted average. You simply divide the total from the amount total. Now what can you see? Now your weighted average is, let's put it here. Weighted average is 6.54. Simple average is 6.46. Why is that? Can someone suggest the reason? I told you in your transactions, if you have more value in the transactions, it should be reflected. Now here, if you look at the interest rate, individual interest rate, there are large volumes at higher interest rate. 7.1, 11 million has been traded in the market. So as interest rates go up and the volume goes up, it is reflected in the interest rate. Now if I reduce this 11 million into 1, you will see this weighted average is coming down. 6.90 now. If you increase this 11 million, let's say into 110 million, your weighted average further goes up. But simple average does not change. So this is the idea of weighted average interest rates. Clear? Sometimes you will need it in the real life. That's why I calculated it. Any questions? Students, are you there?
Yes, sir. Clear.
Any questions? No. So this might be helpful for you in your day-to-day life. In your office life, office environment, this may be important. Now let's move on. For government securities also, you can calculate that weighted average rate. When we take the interest rates of the government securities, you call it yield rates. That is the term we normally use. Yield rates. Yield rate means the interest rates on the government securities. Now there are yield rates we monitor by the central bank monitors two types of yield rates. Yield rates for primary market and the secondary market. Primary market means whenever the primary dealers come to the central bank and buy treasury bills or bonds at the auction, that you call as the primary market. Now in this chart we have primary market treasury bills. Treasury bill bonds also we have primary market rates, but it's really difficult to draw a series like this. The reason is there are various tenors, 5 years, 5.1 years, 3 years, 3.2 years, likewise various tenors are there. So it's really difficult to have a consistent series. So you can't draw a chart for primary market treasury bonds, but bills we can do like this. So if you look at, there are 91 day, 180 day, 364 day interest rates based on this auction data, right? On the right hand side, we have the secondary market yield curve. I hope you remember we talk about yield curve. If I go back to our slides, remember this chart, yield curve. In the yield curve, what do you plot? Basically, the interest rate and the maturity, tenor. Interest rate and tenor is basically plotted. So in this chart, we have plotted interest rates and maturity for Sri Lankan government bonds and bills. Why you call it secondary market? This is the trading market. Primary dealers who have purchased the securities, they are selling in the secondary market. People who have already purchased securities, they are selling in the secondary market. Through these sales, you basically identify some interest rates in the secondary market. So if you plot that interest rates and the maturity means whether it is 1 year, 2 year, 3 year, likewise, you will get some. Let's draw a yield curve. Let's say at 1 year, this is the rate. At 2 years, this is the rate. At 3 years, this is the rate. 4 years, this is the rate. 5 years, this is the rate. Likewise, you can plot these interest rates against the time and connect them. It becomes the yield curve. So in this chart, we have the yield curve drawn for many periods. Now let me ask some questions from you. What are the observations on this yield curve? At least we can take some two important observations as we have already learned last week. What are the observations of this yield curve? Can you identify two important facts about this yield curve? This is yield curve in Sri Lanka, the latest yield curves up to 2020.
When the maturity period is increased, the
Hmm.
interest rate also will increase.
Great, good observation. So what does this mean? What does that mean? We have an upward sloping yield curve, isn't it? When maturity goes up, interest rate is going up. So yield curve is having some upward trend. And in financial market, this is considered as the normal yield curve. Longer the duration of the financial instrument, you have to pay more interest. That is the idea. What is the other observation? Hmm? Any idea? What can you see about these different years? 2018, 19, 20. Based on those different years, what can you observe in relation to yield curve?
Interest rate has decreased.
How do you gauge it? How do you identify it? Yield curve is shifting across periods, isn't it? Now, at a particular point, this yield curve, if you are trying to draw a yield curve, you can draw it at a particular point. In 2018, if you take all the interest rates and plotted, you get this red line. You cannot draw it as a continuous line, yield curve, right? So at one point, you can draw only one yield curve. So in this chart, we have four yield curves for four periods of the from the 2018 to 2020. So if you look at these yield curves, you will see there are shifts, parallel shifts up and down of these yield curves, isn't it? Compared to 2018, the red line, 2020, the green line has come down or gone up. Which direction? From 2018 to 2020, the yield curve has gone down or gone up.
Gone down.
It's gone down. What does that mean? Interest rates in 2018 are higher than interest rates in 2020. So as someone said, interest rates are going up and down, that can be monitored from the yield curve. If interest rates go down in the economy, yield curve should shift downwards. If interest rates has gone up in the economy, yield curve should shift upwards. Okay. So that is an important indication of the movements of interest rates in the economy, yield curve. Now the market interest rates. Commercial bank lending and deposit rates, those are the key market interest rates. Here we have a whole lot of interest rates, and I really grateful and really thankful if you can come up with the definitions for all these different weighted average rates. I think I requested you to look at the annual report last week and give me some definitions for these interest rates. I hope you were able to do it. Can you basically voice your answer so we can all could be heard and we will learn from your knowledge. So what is AWPR? Does someone want to give the definition?
is based on interest rate applicable on short-term rupee loans and advances granted by licensed commercial banks to their prime customer during the particular week.
Exactly. I think you have referred to the references very well. The very clear answer is given. AWPR means AWPR is the acronym, but the definition is, or the long lengthy name is average weighted prime lending rate. Average weighted prime lending rate. So you can define it as the weighted average rate of all short-term loans given to prime customers of commercial banks. Weighted average rate for short-term loans based on the prime customers of commercial banks. Who are the prime customers? What do you
Current
mean by
account
prime
holders.
customers? Hmm?
Current account holders.
Sorry,
Current
current
account
account.
holders.
Not only the current account holders,
All the
mainly.
facility need people.
Sorry,
Yeah, current account holders, OD people.
current account holders, definitely they should have a current account being prime customers. But prime means they are the most credit worthy, important customers. In every bank, there are most credit worthy customers, right? Who are borrowing in large scale, who are very loyal, and who are very long term, maintaining long term relationships. Credit worthy means they are having a very good credit standing. No defaults, no ODs. ODs are there, but honored on time. That is the idea of credit worthy. Normally, credit worthy customers get a low interest rate compared to others. If it is a big company, they normally get a good rate, lower rate. And that reflects the short term market. In the short, they are borrowing basically for short term funding needs, not for capital purposes, right? So if you calculate the rate for the short term funding for prime customers, it is the weighted average prime lending rate. In this chart, you will see the AWPR is given by this orange color line. So this middle line, basically the AWPR. Then what is AWLR?
Is based on interest rate of all outstanding rupee loans and advances extended by licensed commercial banks.
Yeah. AWLR is the average weighted lending rate. Average weighted lending rate. It is the weighted average rate for all outstanding loans of commercial banks for their customers. Now, there is no differentiation whether it is prime or not. All outstanding loans, the loan stock is taken. People like us, when we borrow, our rate is captured by this AWLR. Our credit card loans, housing loans, mortgage, everything, car loans, everything is captured here. So this is the weighted average rate for all outstanding loans of the commercial banks. If you look at this chart, you will see AWLR, the purple line. It is basically the highest in this chart. What does that mean? Normally, we pay high when we borrow, right? If you are a credit-worthy prime customer, probably your rate will be little lower. But other than that, AWLR indicates the entire economy's borrowing rate on average. Okay. Then we have AWNLR, average weighted new lending rate. Average weighted new lending rate. Do you have the definition for that? I'm sure you should have.
Yes, I have all.
You have. You went through the
Annual
definitions.
report.
Yeah,
Yes, sir.
good, good. Let me know.
Captures interest rates at all new rupee loans and advances extended by Russian Commercial Bank during the particular month.
Yes. There are only differences. In AWLR, you have all outstanding loan. Outstanding loan means what? Loan stock. But in this loan stock, you have new loans, old loans, high rates, low rates at different time periods, isn't it? In order to see the new or the current interest rates, you should have loan rates for new loans given in a particular period. So under AWNLR, you calculate average weighted new lending rate uh, in the commercial banks. So weighted average rate for new loans in a particular month granted by commercial banks. And I'm happy actually when I was the head of money and banking of the central bank, I basically introduced these two rates, AWNLR and AWNDR, to basically understand the movements of new interest rates in the economy. So those have become very established rates right now. We introduced this with my team somewhere in 2014-15. Now they are actually well established rates monitored by the market. So again, back to the lesson, NLR means based on the new loans. If you look at this chart, again, you will see this blue line is the new loans. Now, if you look at the very recent period, there is a difference between the average lending rate and the new lending rate. What does that mean? New loans rates are coming down compared to the total stock, isn't it? So we can get some real feeling about the movements of the interest rate. So these first three are the lending rates, and then we have the deposit rates. First one, AWDR. What is the definition?
Average weighted deposit rate.
Yes,
It is calculated on a monthly basis on all interest-bearing rupee deposits held with commercial banks.
exactly. Great. AWDR, average weighted deposit rate, which means the average weighted for all rupee interest rate for all rupee bearing deposits. All average weighted interest rate for all rupee bearing deposits. Rupee bearing, not rupee bearing, let's say average weighted interest rate for all deposits in rupee terms. You don't take foreign currency deposits here, only the rupee deposits are taken. And if you take the deposit portfolio, you have various deposits. You have savings, you have time, you have call, you have various types of deposits. If you take the entire deposit portfolio, the stock, and calculate the interest rate based on these different products, that we call as the average weighted deposit rate. So I'll repeat, average weighted deposit rate is the weighted average of all interest rates offered on rupee deposits in a particular period. In this chart, the lowest line is the AWDR. If you look at this red line, this is the the lowest rate in the economy. So that indicates on average what we receive for our deposits. Now, if you look at this, the lowest rate, the highest rate, that indicates the difference between AWLR and AWDR. DR. This is the interest rate spread in the economy. In banking terms, you call it NIM, net interest margin. So net interest margin in our economy is close to 6%, isn't it? 14 minus 8. So the banks are maintaining that much of a spread for our deposits and loans. That is the idea. So that is bank's profitability, indicating the profitability basically. There are some other administrative costs and all that, but simply that is the spread. Then we have AWFDR, average weighted fixed deposit rate. Can you define it?
It is the weighted average rate of all outstanding interest-bearing rupee time deposits held with commercial banks.
Yes, correct. Only one correction. Can you repeat it again?
It is the weighted average rates of all outstanding interest-bearing rupee time deposits.
Rupee time deposit. Correct, correct. I heard this as prime deposits. Sorry. Rupee time deposits. Correct. So this rate calculates the weighted average for time deposits or the fixed deposits in the economy, right? In AWDR, you have all fixed and savings both, but you need to know what is the long-term interest rate in the economy for deposits. For that matter, you calculate AWFDR, which is the weighted average for or average weighted fixed deposit rate, which we define as the weighted average for all rupee denominated fixed deposits in a particular period. Both these rates are based on the stocks. Stocks means the available money amount. Okay, the deposit amount, the total stock of amount, not the money, the total stock of deposits. Again, if you need to know what are the current movements of deposit rates, you should have to have new deposit rates calculated. So the last rate is serving for that purpose. Weighted average new deposit rate. Does someone want to define it?
Yeah, it is also calculated on a time average new deposited based on the interest rate pertaining all new interest bearing rupee deposit mobilization by licensed commercial banks during the particular month. It's kind of a new loans.
Yes, very similar to new loans. Average weighted new deposit rate is the deposit rate offered by commercial banks within a month. So you take the average of all these new deposit rates to see the movements of new rates in the economy. So in this chart, if you look at this green line, it's the new deposit rate. So normally it's higher than the AWDR. Why? It captures new deposits in the economy. And then going down in the chart, if you look at the latter part of the chart, you will see new deposit rate is higher than the lower than the AWDR, which indicates deposit rates in the economy have gone down. Give me a minute. Any questions on this, students?
So regarding this, I don't have any. But when I was reading the chapter 7, I have found one thing: AWSR. It is it means the outstanding loans and advances extended by the licensed banks, SME sector, and excluding refinance scheme of the.
Yes.
So
Now
AWSR defined as.
it is actually, I think, even I am not fully aware of this. This was introduced very recently in the annual report for small and medium scale enterprises. Now banks are giving loans to them also, similar to prime customers. You give loans to the small and medium term enterprises. And the central bank has started monitoring the rate for those categories as well. It's actually at testing stage. I think there is a box article on the results of this survey, and it has not published as an official rate yet. Okay, so in the annual report, it has basically introduced this time. Going forward, it can be an established rate, but it's good you raise that point, that is calculated for SMEs to understand the rates given to them. Okay. Right?
Sir, thank you.
Right, okay. Now, if you read the annual report, probably you may have seen there's another rate. I have not taken it here. Now we have NDR now. You can also calculate, and it is calculated AWNFDR. What is that?
Average weighted net foreign deposit rate.
No.
No, sorry, sir. Average weighted new fixed deposit rate.
Exactly, yeah. We have this FDR now and NDR now. Similar to that, we can calculate a new fixed deposit rate also. Actually, it is calculated by the central bank. I remember it's in that table, 7.102 table, it's there. But let's rely on these 6 interest rates, important rates of commercial banks in the economy. And you can see from this chart, all interest rates have indicated a decline during last year. Then there are some other interest rates in the economy which are published by the central bank. I'm referring them as other interest rates. One is legal rate, other one is market rate. Both these rates are actually applicable for court cases. Court cases. If there is no specific rate is mentioned in a financial contract, in the courts, the compensation is determined based on these rates. For example, if you want to pay someone decided by the court will take these rates into consideration, legal rate and the market rate. By definition or by way of calculating, these two rates are the same. Only difference comes from the act or the law. Legal rate is coming from one law, that is Civil Procedure Code. Market rate is coming from another law, Debt Recovery Act. Right? Through these different legislations, you have different definitions, but broadly, two rates are the same. Why it is same? They are calculated in the same way, taking the deposit rates in the. So every year, the central bank publishes this rate in the Gazette for the following year. By this December, the rate will be published for 2022. So likewise, during last many years, I have plotted given the numbers of these rates. There's no significance of these numbers. Only thing you need to understand, both the legal rate and market rate, they are similar. If you look at these numbers. So for 2021, the rate is 10.12. If you go to the courts and court is decided for any compensation or any settlement, the applicable rate will be 10.12. Then let's look at some of the international interest rates operated in international markets. There are two main important interest rates in the international markets. One is the Fed funds rate, federal funds rate. Federal means this is actually published or relevant to the USA market. So the federal funds rate is the benchmark rate of US in the United States economy. So what do you mean by Fed funds rate? Interest rate at which depository institutions, which means banks, lend reserve balances. Reserve balances means they are excess or deficit money, like in our case, to other institutions on an overnight base, which is an collateralized basis. Uncollateralized means there's no security involved. Even in a coal market, I forgot to tell you, this lending and borrowing happening without any collateral. No securities are kept as collaterals, right? Uncollateralized means no securities involved. US market also, this uncollateralized loan average rate, we call it Fed funds rate. So it's very similar to our AWCMR. So it is the benchmark interest rate for the US economy. And when the monetary policy is changing, this change will go up and down. Now, if you look at this chart, I have given you the Fed funds rate, the movements. So you will see the rates are going up, going down. This is very much related and connected to the monetary policy changes of the US. Now, these days, US is having a policy of having extremely low interest rates. Now, you can see during the crisis period also, they had interest rate closer to zero. Even now, during the COVID pandemic period, they have interest rates at very low levels. So this is the benchmark rate for uh, for the US economy, and that is an international rate because most of the international markets rely on this rate. And the other most important rate in international market is the LIBOR, London Interbank Offered Rate. So this is in the UK economy. London means London financial market. So what is this rate? It is an indicative rate for a panel of banks who are prepared to lend in the market. This is not an actual rate. LIBOR means not an actual rate. It indicates some willingness of the banks to lend. In the morning, banks would say, okay, I would lend at this rate. So if you take the average of these willingness or the indicative rates of all these banks, a panel of banks, then it indicates then it is the London Interbank Offered Rate. This is calculated for 7 maturities. So in this table, you can see there are 7 maturities: overnight, 1 week, 1 month, 2 month. Likewise, there are various maturities up to 1 year. And also they calculate it for 5 different currencies. So there is LIBOR for USD LIBOR, GBP LIBOR, Euro LIBOR, Japanese yen LIBOR, Swiss franc LIBOR, and this can be extended to any other currency also based on the major currencies in the world. LIBOR is considered as the most important benchmark short-term interest rate. Most of the financial contracts are priced based on LIBOR. Probably you may have seen in contracts LIBOR plus 5%. So 5% is the margin. LIBOR is the basis or the average for the all rates for the contract. Okay. So if you look at the movements of the interest rate, you will see even LIBOR is at very low levels because of the current rises in the markets and the most of the economies. These rates have also become very low.
Sir, are they collecting collateral for this?
No, this is indicative. No, indicative means that there's no actual transaction, right? If the transaction happens, it is not collateralized. Why? It is also call market. Interbank means call market. No collateral is involved, and any case there's no collateral here because it's an indicative rate, no actual transactions. That gives some guidance to the market. Okay. Then monetary policy and interest rates are very closely related. I wanted to highlight this point. When the central bank is changing its monetary policy, interest rates are changing. Now in this chart is the interest rate cycle for Sri Lanka All these green areas indicate relaxed monetary policy. All these red areas indicates tight monetary policy. Relax means interest rates are going down. Now, if you look at these green areas, you will see interest rates are going down in all green areas. On average, rates are going up. In red areas, what you can see, interest rates are going up, tightening. How do you monitor this going up or going down? If you look at this black line and the ash line, those are the policy rates. Remember, policy rate corridor? So that corridor is going upwards and going downwards depending on the monetary policy cycle. Now, how this cycle is decided, if you look at this chart again, you will see there's a dotted line. What is this dotted line? That's the inflation. So when inflation goes down, interest rates are going down. When inflation is going up, interest rates are going up. So interest rate cycle in the economy is very much close with the inflation cycle of the economy. Inflation and interest rate, they are very closely related. Okay. And these changes in the interest rates are affecting the financial markets and the banks, everyone. As we are customers or the average public, the interest rate changes are affecting on us. Similarly, financial markets, banks, everyone will be affected due to the interest rate changes. Especially if you look at the banks, due to the changes in interest rates, their profitability is affected. Remember, I told you this interest rate spread, NIM. NIM is basically the difference between the lending rate and the deposit rate. So when the rates are changing, this net interest margin is changing. So which means profitability is changing. Usually when interest rates are going up in the economy, banks make high margins. Their profits are going up in interest rates cycles when rates are going up. When rates are going down, their margins become narrow, but banks anyhow try to maintain such margins. The assets will be affected. Why assets will be affected? Interest rate are linked to assets in two ways. One, for loans. If loans are given at variable rates, when interest rates are changing, that will affect the income of the bank. And also, banks are making investments in securities, treasury bills and treasury bonds. When interest rates are changing, the value of securities are changing. I will show you when we come to financial instruments. The value is changing due to interest rate changing. So all these affect the assets of the banks. And then the cost is affected by this interest rate changes because banks are also borrowers, right? They borrow in the interbank market, they borrow in capital market, they borrow from other institutions. So they also have some interest cost. So that interest rate cost will change when the interest rates are changing in the economy. So banks, their main variable, their most important variable is the interest rates. Okay, now when we have these exam questions, I think you can attempt to these exam questions on your own because most of the things we have covered. Now, I will give you one or two answers which have not been covered in the discussion. Now, there's one particular point here, SLIBO. Here we have LIBO. LIBO we already know, London Interbank Offered Rate. What is LIBO?
Sri Lanka.
Sri Lanka Interbank Offered Rate. So why did I discuss it? Now SLIBO is not calculated and published by the central bank. It is discontinued. Okay. So similar to LIBO, SLIBO indicates the bank's willingness to lend in the market in a particular day, at which rate they would like to lend. That is the idea. Clear? Then, as I said, there are some questions on the numbers. What is the current SDFR? I think we discussed. Currently it's 4.5. That can change at any point. Then we discussed the real interest rate. Remember, real interest rate means inflation adjusted rate, and why it is important for the savers. Their purchasing power of money will be determined by the real interest rate because it is inflation adjusted. And here we have a question how to calculate the real and nominal rate. So here inflation rate is given, real rate is given. What is the nominal rate? I hope you remember nominal interest rate is the inflation plus real rate. Remember, we have done these things in the class. So some definitions are there. AWLR, LIBO, right? We have covered these things in the discussion. And here there's a question, weighted average prime lending rate to borrowers. So central bank policy rate to commercial banks. Now here, it's not only definitions, you have to give some elaboration on the importance, right? Why these rates are important. I think we have covered them in our discussion. Now this 2019 question, what is the applicable interest rate when licensed commercial banks borrow from the central bank on overnight basis? I hope you remember we discussed SLFR. SLFR is the rate that the commercial banks borrow for their funding needs on an overnight basis by placing collaterals with the central bank. Collaterals are the treasury bill and bonds. Now this is the very latest paper, and if you look at the first question, it's all about numbers, right? You have to know numbers. What are the current rates? What was the change recently? You have to know. For this matter, you need to look at the monetary policy review of the central bank very closely. Okay. I told you one day also, you have to very closely monitor what are the information coming out from the central bank. So new rates are available there. So the next monetary policy review is coming out on 19th August this week, right? So you have to basically look at this monetary policy review, and I really recommend you do this because I'm planning to have a session next week on the latest monetary policy review for you to get some understanding and how it is written, what are the key messages out of this review, what can we basically infer out of this review. Those will be discussed in my next session at the very in the first half an hour or so in the next class. I'm planning to discuss the monetary policy review. So have a look into the monetary policy review. As I said, it is published on the www.cbsl.gov.lk or any website, any paper, newspaper, even media. You will find this information, monetary policy review. That will be published on 19th August, and that will give you the new rates if the rates are changed. We don't know. Central bank might change or not, but that will be an important document. Briefly discuss the bank rate. Today we discussed, remember, the bank rate has been inactive for many years. Inactive in the sense it is kept as constant for many years. Now the central bank has started adjusting that rate. If you remember, we mentioned it as SLFR plus 3 percentage points, right? So you need to know how to define it. We have done it today. Okay, we are done with the interest rate discussion today.
So, do we have any extra classes, sir?
Extra classes for our course. Now, what we were told is actually now we have this earlier. I think the plan was to have the exams in November, so we had enough time. But due to the advanced level issue, I think your exam has been advanced to October. So, assuming we have exams in October, we were requested to have some extra classes, but still, I didn't give any extra dates up to now. The reason is I'm planning to cover the discussion in our normal sessions. Probably I might need one or two maximum because we are basically on track. The other reason is we are not so sure what's the direction, right? Now, currently, we are in a really distressed situation in this country. I'm really wondering why we are, into this situation. Every day we hear more than 150 people die. So I think we are in a kind of a grave situation, and we are not so sure what's going to be the direction. So let's wait few days or 1 or 2 weeks to see where are we heading, and remember, let's see whether we need to have any extra classes, and accordingly we will plan. But take my word, I'll be basically covering whatever needed for the exam, and we are basically on track.
The classes will be starting at 7 or 8, sir.
8. Regular time is 8. Why you log into the session 7 a.m. today?
Yeah, something I got, so I love, but after that, got to know it will be started at around 8.
Yeah, because I think last week I made it very clear we will start at the usual time. So next week also usual time 8 o'clock. If I have any change, I'll let you know. Someone is asking in the question paper, they are asking to write definitions of these interest rates. Yes, definitions are there. For AWPLR, SDFR, sometimes there are definitions. So you have to write it. I think I made it very clear. I discussed definitions very clear. Okay. Any other questions? Now, today I shared two slide set with you. One is on the next session, financial institutions, especially we start with the central banks. So take a look into that slide set before you come to the next class. And also I shared some additional slides with you on financial press. Right? Financial press means basically I want you to look at the news, financial news around you. So basically look at financial news and discuss, be aware of the financial developments around you. So for that matter, you have to look at the financial news, so the press. So I will give you some brief indication about these hints or the hints to look at the financial press next week. But have a look into those slides, and at the end of the slide, I have mentioned this monetary policy review, right? So you have to look at the financial press as well as the monetary policy review according to the slide set. Okay. So you are saying you didn't get the past papers, and someone of you have said it will be shared this week, right? You will be getting past papers this week. So don't worry. Any questions? I think we can wind up today in a while. Do you have any questions to be clarified? No questions? Yes, I'm plan. I was told this request last week also. Actually, that's in my plan to have a online quiz. Yes, I'm going to have it very soon. Very soon. Definition for AWNDR. What I said was it is the average weighted uh, rate for new deposits within a particular month. Average weighted interest rate for new deposits within a particular month. Okay, I think we can wind up. So my request: stay safe. Don't go out for any reason. That is the best advice I can give. Even I'm under quarantine these days, 14 days quarantine because of issues in my office. My parents, most of family members got infected, so passing a very tough time. I'm sure most of you have the same issue. It's really hard to find a person or a family without any connected case to COVID. So it has become to that severe level. So be safe, don't go out for any reason. Maintain your social distancing, all these health guidelines. This is a very crucial time that we are passing in our lifetime. Once in a century, I guess, but it's really difficult time. So be safe, take care of yourself.